I'm Stuart Jackson, Portfolio Manager at Montgomery Investment Management. Welcome to this week's Video Insight. This week, we look ahead to the upcoming bank reporting season. The banks have dominated the media headlines for all the wrong reasons over the last month. Revelations from the Royal Commission have shown that even when the banks were already sitting at the bottom of a very dark pit, in terms of public perception, there's always the ability to dig a little deeper. Given this backdrop, the first half results come at a very interesting time. Needless to say, the media will inevitably demonise the banks for their multi-billion-dollar profits they will report, but will neglect to highlight the hundreds of billions of dollars they have invested in the Australian economy to realise those profits. Looking at the outlook for the financial results themselves, the headwinds that have been slowly building over the last couple of years are likely to continue to grow in the first half. In terms of revenue growth, data published by APRA and the RBA show that loan growth is slowing. At the same time, benefits from mortgage repricing last year will be starting to fade as a driver of net interest margins. Mix is likely to be a negative for net interest margins due to the consumers rotating from higher rate interest-only loans to principal and interest, as well as the weakness in business lending. At the same time, the banks will be absorbing the full period impact of the bank levy. Consensus forecasts imply flat to slightly lower net interest margins in the first half. This might prove a little optimistic. The outlook for net interest margins in the second half is looking even more challenged, with ongoing mix issues and rising wholesale funding costs resulting from the recent spike in the bank bill swap rate. Repricing to offset rising funding costs would be nearly impossible at present, given the current political environment. Non-interest income has been relatively flat over the last few years. This is unlikely to change in the foreseeable future, given the public relations backlash fee increases would incur. The weak rate of growth in revenue puts a lot of pressure on operating cost control to deliver even flat earnings. All the banks have internal cost reduction programs. As a result, consensus forecasts are assuming flat to falling operating costs for the banks in the first half. This of course excludes the one-off restructuring costs already announced by NAB, which are designed to reduce headcount by around 4,000 full-time equivalents over the next 3 years. Despite being at extremely low levels by historical standards, bad debt charges will again provide a boost to bottom line results given the reported charges from the first quarter Pillar 3 statements. While I feel a bit like a broken record, it must be reiterated that this line item will mean revert at some point, putting profits under downward pressure. Therefore, using current earnings as a measure of the long-term sustainability of dividends is fraught with danger. There will be a big focus on any comments regarding the outlook. Net interest margin pressures are likely to continue, as is the slowing rate of loan book growth. But we'll be looking for signs regarding any restrictions on the availability of credit resulting from the increased risk aversion and fear of regulatory pain emanating from the Royal Commission. The implication of a tightening of credit availability would have far-reaching effects that extend well beyond the banks, potentially threatening the outlook for the broader Australian economy. And on that cheery note, that's all for this week. We'll be back next week. In the meantime, you can follow us on Facebook and Twitter.